This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Commodities traders such as Trafigura and Vitol have helped keep Russia's oil flowing through its Baltic and Black Sea ports in March, when some Western firms started to snub the market, according to ship tracking, traders and shipping sources. Both Swiss-based trading houses have long-term deals with state-run Russian oil giant Rosneft to load crude under agreements struck before Moscow's invasion of Ukraine triggered a wave of Western sanctions this month. So far in March, the two companies combined have loaded 22 cargoes of Urals crude, equivalent to 2.32 million tons of oil or 16.7 million barrels, according to Refinitiv Aecon ship tracking data and sources. They shipped 1.84 million tons in February and 1.80 million in January.
The United States will work to supply 15 billion cubic meters of liquefied natural gas, LNG, to the European Union this year to help it wean off Russian energy supplies, the transatlantic partners said on Friday. The EU is aiming to cut its dependency on Russian gas by 2/3 this year and end all Russian fossil fuel imports by 2027 due to Russia's invasion of Ukraine. Russia supplies around 40% of Europe's gas needs. Concerns over security of supply were reinforced this week after Russia ordered the switch of gas contract payments to rubles, raising the risk of a supply squeeze and even higher prices.
Moving on to the top news in the energy sector.
EU leaders failed on Friday to agree a short-term solution to the energy market crunch made worse by Russia's invasion of Ukraine, but did offer a compromise for Spain where spiraling fuel prices have led to 12 days of trucker blockades. An intense debate on whether to cap energy prices, pitting some southern countries against Germany and the Netherlands, pushed the second day of an EU summit into the evening, with Spanish Prime Minister Pedro Sánchez at one point walking out of the meeting room. In the end, they settled on trade-off and left a number of issues unresolved.
Crude prices rose more than 1% to over $120 a barrel on Friday, as traders reconciled the impact of a missile attack on an oil distribution facility in Saudi Arabia with a possible release of oil reserves by the United States. Brent crude settled up $1.62, or 1.4%, to $120.65 a barrel, and U.S. West Texas Intermediate, WTI, crude ended $1.56, or 1.4% higher, at $113.90. Both had dropped $3 earlier. Yemen's Houthis said they launched attacks on Saudi energy facilities on Friday, and the Saudi-led coalition said Aramco's fuel distribution station in Jeddah had been targeted by an attack, but that a fire in 2 tanks at the facility had been brought under control.
Next, we have the top news in metal markets.
Surging European steel prices are set to extend their gains as Russia's invasion of Ukraine has disrupted logistics, spurred sanctions and sent energy prices soaring. Russia is the world's 5th biggest steel producer, while Ukraine comes in at 14th. The two combined account for a fifth of imports to the European Union. European hot-rolled coil, HRC, prices have shot up by nearly 40% over the past 3 weeks. Prices in North America and China have also gained, but by much less, around 7 to 8%.
Gold was on course to gain for the week as concerns over the war in Ukraine and rising prices boosted its appeal as a safe haven and an inflation hedge, but prices eased on Friday as U.S. Treasury yields reached new highs. Spot gold fell 0.3% to $1,952.60 per ounce by 1:49 p.m. Eastern Daylight Saving Time. U.S. gold futures settled down 0.4% to $1,954.20. Helped by expectations of monetary tightening by the U.S. Federal Reserve, yields on the U.S. 10-year Treasury note firmed near multi-year highs, increasing the opportunity cost of holding zero-yield bullion. We will now look at the top news in the agricultural sector. India plans to restrict sugar exports for the first time in 6 years to prevent a surge in domestic prices and could cap this season's exports at 8 million tons, government and industry sources told Reuters. An announcement could come early next month, they said. Shares in sugar manufacturers slid on the news, with Dhampur sugar mills and Balrampur Chini each tumbling 5% and Dwarakesh sugar losing 6%. Sugar output is going to be a record high, but stocks are depleting fast because of exports. Uncontrolled exports could create scarcity and local prices could spike during festive season, said a senior government official with knowledge of the matter who asked not to be identified.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.